given a talk here, was it last month, down in Orlando?
Yes.
And so those who were there, I don't want to repeat myself, so I'm gonna give it a different discussion this time. They had sent me a number of points or topics that they thought you guys might want to be interested in. So I'm gonna try to cover 3 or 4 of those, and then which will be, I put them together, the trends in the office markets and technology. To me, they're kind of interrelated together with demographics changes. Public versus private. I'm in the public market now and used to be in the private market for 25 years. So I'll go to that. And then the last part that everybody seems to want to know is, how do you invest for your own account when you don't have any money? I mean, how do you start that? How do you do that, right? So I'll get into those topics, and then, but I would like along the way for you all to ask questions, and maybe, in the middle of what I'm discussing, please raise your hand if you have a question about it. So I'd like it to be interactive.
For the folks who don't know you, can I take a minute?
Oh, sure,
tell them
sure.
who they're looking at here? Okay, great. I just got to it's Jim Heistand, of course, President and CEO of Parkway Properties, which if you go out on the website, it doesn't take you long to figure out it's a pretty impressive REIT. Jim is the newest member of our Hall of Fame, and this is for his lifetime leadership and contributions to the Florida real estate industry. He also was recently honored by the city of Orlando as the CEO, or by Orlando Business Journal as the CEO of the year. And I suspect a lot of other people have done similar things. But he graduated from here at the UF with a degree in real estate and urban analysis, 1974. From there went through a string, I won't list them all, but a string of fascinating leadership roles in various different kinds of investment groups and development groups based in Orlando, but reaching well beyond. One of his key ones was the Associate Capital Properties, which he founded in 1989. He sold that after a few years to Highwood Properties for $622 million, which was back in a time when that...
I didn't get all that. There's partners, there's debt, so...
And then he went through several others, and finally, but in 2000 he founded Eola Capital, which was kind of what we knew him for in many ways. One of the largest investment groups in the eastern United States, very successful. And then in 2011 he merged that with Parkway Properties, and it became a REIT, and he'll probably tell you a little about that. And as I say, if you look on the website, you can see that it's a prominent and glamorous and very successful story. So, in short, Jim has made UF proud, he's made Orlando proud, he's made Florida proud, and we're proud to have you here, Jim.
Thank you, Doc. And he was here when I was here. He was one of my professors. So, he's older than me, right? But thank you for that. And, and I listened to all that and I told this to the doctor when they put me in the Hall of Fame. For full disclosure, my first year here, I was on academic probation. Okay, you had to live in the dorm, and we spent all of our time in the study hall, drinking beer and playing poker, as opposed to studying. So the point is, you still got time if you're not doing it right now. What I thought I'd kind of go through, a lot of people are talking, especially in the office business, it's changing so much. And it has changed. I mean, if you think about how people use office today from before, and if you're thinking about how you're going to invest, you got to make sure you understand where things are going. And it's amazing how things have transformed in that people use considerably less space than they used to do. A law firm is the primary example. I mean, I don't remember a law firm or a bank in the last 10 years that we've renewed who hasn't downsized. Okay? And and the technology has a big part of it. Obviously, it's a mobile workforce. I mean, even me, I'm a low-tech guy. We were doing the punch cards back then. I don't even know how they worked. But, I can do more from my iPad than I could have done 20 years ago. So if you take a law office, they used to have 1 or 2 assistants per partner. And now there's 1 for 4 partners. They don't need a law library. In our shop, we got 6 senior executives. They would have 10 years ago each had an executive assistant. Now there's 2. So the point is, it's changing, and it's changing rapidly. And if you think about, and so what I see is the office market is is bifurcated into 2 types. There's the suburban stuff that you've seen, where they've built these business parks, 3 and 4 story. They tend to cluster around interchanges, and they have little to no amenities that are within a walkable distance. And what we have found is that the new workforce, the people here, besides the fact that people use less space, they want to be next to the amenities. They want to live in an urban environment primarily, has the amenities, they can live, work, they can shop, they can eat without getting in a car. And then the companies want to attract that talent. So what they'll do is they'll come and pay a higher rent, because if they needed 100,000 square feet before, they maybe only need 75,000. And rent is a small component of a G&A in a company. Personnel is the biggest one other than manufacturing. So they'll go pay a higher rent to be in the right location. The suburban office in the past was more of a cheaper alternative. People just don't want it. And it's, in my view, a lot of these places that are in far-flung locations will ultimately get redeveloped, in many cases torn down. I think a great example, for those who know Orlando, take Maitland Center. It's the market has done better, but Maitland Center is still, people don't want to be there because they have to get in their car, they have to go somewhere, and the traffic's horrible to just go get a cup of coffee. So, because of that, what we've done as a company is we looked at, and we're a Sun Belt company, so our markets are Charlotte, Atlanta, Houston, Austin, Phoenix, and Jacksonville, Orlando, Miami, and Orlando. So what we did, this is after the merger 5 years ago, we took a look at the Sun Belt and which markets are going to outperform broadly, and the Sun Belt markets are projected to do both employment growth as well as population growth. And then we drilled down as to where are the submarkets where the companies are going to want to locate and attract the talent that's sitting in this room. And what we came up with was the uptown, downtown market of Charlotte, Buckhead, Midtown in Atlanta, CBD in Austin, Brickell in Miami. And if you look today, this is 4 years since, the broader markets in those cities, so if you went to Atlanta and you say, what is the vacancy rate in office in Atlanta? It's maybe 16 or 17%. What's the vacancy rate in Buckhead? It's single digits. And the other thing that's happened in these Sun Belt markets is there's been so much of this high density residential that people want to live and work near the area that they've taken up a lot of the office sites. So what's happened is the cost to replicate the buildings we bought has become greater and greater. And you really want to invest in an asset class and a market that has an increasing replacement cost dynamic, right? So anybody can build anywhere. I mean, they build in New York, they build in DC, and it just costs them more to do it. So what you want is to be in a market where somebody can compete with you, but if you bought here, it costs them here. That gives you time. That gives you room to run your rates. If you're in a market where the suburban markets, is what I think is where I wouldn't want to invest in. Those rents haven't moved in 15 years. And if you don't have an increasing rent, so you may think you're buying something at a good price today, but the expenses continue to increase every year. So your net rents will actually go down in those markets. The capital costs are going up because just materials and labor still increases. So if your net rents are going down and your capital costs are going up, it's just not a very good investment thesis. And so we've really tried to focus on those markets, and the technology drivers have been huge. I mean, we've entered into again, to attract the companies that want to attract the people in this room. We've entered into a joint venture with Google Fiber where they're putting all the conduit in our buildings. They pay for it. The tenants, obviously, they pay them to use it, but it's 10 times faster than the Comcast or the typical systems out there right now. That brings tenants to our properties. We've really focused on the energy efficiency, Energy Star, LEED certified, because, I will tell you, there's marginal expense benefit, but it's perception. And so these companies come here, they actually want to tell the people who work for them that they're in a green building. And even if it's not saving them much in expenses, it resonates, and they're prepared to pay more rent if you have those amenities and do it. So I think as you're looking out, and it's affected the retail too, no different than office. I mean, you look at these B malls and these they're suffering. They will ultimately get bulldozed. And so as you think about what you want to get into and where you're going to invest, you've really got to, technology is changing so fast that we tried over the last 4 years to get as many of the properties as we could because we just think they're going to increasingly get more expensive, the right ones, and the other ones will just actually be worth less. Okay, so I mean, I think that those trends will continue to go. I don't think we're going to continue to get lower and lower person per square foot. There's almost a diminishing return at some point. People need space, and you can't cram in too many people, or that becomes an unpleasant work environment. But it has changed dramatically. It's been changing over 20 years. But we've tried to invest in those properties that provide that amenity, and it's amazing. Since we've taken over, our rents are up $12 a foot, and the rents in the buildings we have over prior Parkway when we first took over, and we sold everything anyway, by the way, sold it all in 2 years. And our capital costs have gone up $1. So you can do the math on that, and it's been, and not only that, what we tried to do is when we bought these buildings is to get scale. Because if you've done your research and you like a submarket, you want to own more than one property there. It gives you the ability to retain your tenants, and people grow, they contract, you can move them around, you can keep them. We put Pulte Homes in our building in Buckhead right next to the MARTA stop. They relocated from Illinois. 100,000 square feet. In order to give them the contiguous 100,000 square feet, we own the other 2 buildings. We had to do 12 separate transactions to make space for them. If we didn't own the 2 buildings, we couldn't have done that. So you operate them cheaper cheaper person per square foot. Your expenses, because if you're given a contract for somebody on your janitorial or your elevator, you're giving them all 3 buildings, you get a lower price per square foot. So that's been our investment thesis. So it's been tied both to the demographic changes, the millennial workforce, which I know covers a broad area anymore. It seems like everybody's a millennial. I don't know who qualifies in here, who doesn't, but that's all you hear from the companies that rent space from us. They want to make sure that they lease in an environment that's going to attract the people like you in this room. That's their number one thing. And so if they'll pay the extra freight to get what they want. And they won't even look at the property that doesn't have all those characteristics. And I think retail is going through a similar dynamic as well too. I mean, there's some people who I've known who have bought some of these B and C malls, thinking they went in at a 10 cap rate, and this is a great number. And that cap rate is probably going to be 12 in 5 years from now.
You're seeing a shift in terms of the office space, and I know a lot of technology firms and things like that are using like big bullpen, big open rooms.
Yeah, there's much more open space component. The traditional walled off office, is not the case. You want it open, you want it more interactive. That's typically where it's going. So you'll see a much more, and even if you do have the enclosed office, it's typically glass today. So anything on that particular topic that I can answer to anybody?
Are you looking to the future? Do you see the submarkets that you're focused on, like do you see them expanding and your client base going to surrounding areas? Is that?
No, I think, as we sit here right now, I'd like to get into some other markets that have those same dynamics and also gain more scale in the submarkets we're in at the right point. The prices have run up pretty good. We were buying 3 and 4 years ago. We bought $4 billion over the first 2.5 years. The pricing now has gotten to the point where it's at or above replacement cost. So I'm less of a buyer. Actually, I'm more of a seller right now in some of those markets. And I'll get into the next subject is, public or private, but it's more challenging in the public arena to take advantage of that because you have to have a certain scale and there's certain REIT rules where you can't buy and sell real estate or you lose your REIT status. So we'd like to get more. I mean, we've got 6 buildings in Buckhead. Because we like that submarket. So would I like to own more? Yes, but not at the price point today that they're being offered at. So we may recapitalize some of those that we own that we bought for $250 a foot and they're worth $400 a foot. And so maybe we go do an 80-20 JV with JP Morgan where you're still operating it, you're still in the market, but you've taken 80 cents off the table of the chips that you invested going in. So we would look at that, but still keep our presence there to do it.
So I just find it interesting. You're in Charlotte, Atlanta, Brickell, and Austin.
Well, we're in Tampa. We're in West Shore in Tampa. We're in downtown Orlando.
Okay, but you've leapfrogged Dallas and Houston. Why?
Well, no, we're in Houston as well too. I'm sorry if I missed that. We didn't leap. We missed it on Dallas as we kind of did an overview of where we wanted to invest. Dallas isn't like the markets are a little bit more unique there. The downtown isn't where I'd want to invest. And so we were concerned about it, and we missed it, and it's done extremely well. And it's actually more diverse because our Houston stuff right now is a bit tainted given the price of oil right now, where it
Is
is.
it all in the loop primarily? Or?
Yeah, we're in the loop. We're in the West Chase, Greenway, and Galleria area.
Okay. And do you think that sort of idea that the suburban office park where everybody has to drive to every given thing is going to make areas like the Woodlands just significantly depreciate, or do you think that they're going to be able to?
Well, the Woodlands is all the new stuff with ExxonMobil up there, right? I mean, so they've created almost a self-contained, amenity package. We own a building called a property in West Chase called BMC Software. It was the BMC campus built for that, so it's beautiful real estate, but it's self-contained in that we have all the amenities on this campus. We've got a car repair, we've got 3 restaurants, we've got a Starbucks, there's volleyball courts. I mean, it's a self-contained, it was basically a tech campus from San Francisco put into Houston. Although it's 4 different buildings, total of about 1.5 million square feet. So they don't have to leave the campus for those amenities. What's interesting in Houston for that is the energy companies, they build a lot of their own campuses. Next door to us, Phillips Petroleum is just building a big one. But if you're a smaller energy company and you want those amenities, and as you know in Houston, it's spread out, okay? So it's too expensive for them to build their own amenity campus for just a smaller user. So what we have here is we can do multi-tenant, so it's not a self-contained, but it's still secure, and they get all the amenities without paying for their own campus to do it. So it's worked, it's stayed full. Even in this environment, it's still very much in demand because of that. I'm sorry, he asked first.
I noticed on your website they have a property in Philly on your portfolio. So I'm wondering if you have plans to expand.
It's close to being under contract to sell, and that was part of a portfolio that when I sold my company into Parkway, one of the assets we owned. So it's not the markets that Parkway would operate, but we had to hold on to it till we just renewed Cigna, who took half the building. And once we renewed them, now it's time for sale. So we're not expanding more in Philly. That's where you're.
So you're basically restricting yourself to the Sun Belt area.
Correct. One of the things I'd like to get into would be DC. I mean, my view is I don't think it can get any worse from a dysfunctional standpoint in DC the last 8 years. So I think DC will get better. But one of the things that's important too when you go into a market, and one of the ways we've set up our operation is, real estate, don't ever forget, it's still a local business, right? What was the guys at Highwoods, how'd they term that? They don't want to get homeboyed. Okay, so if we would have people in those markets, and so like the Kyle Bird, who's run Tampa for me for years, he was a 20-year broker at CB. I mean, he sees every deal, knows every building, knows which buildings have leased in down markets, which one gets the highest rents. So with someone like that, they give us the intel as to where to invest. So if I'm going to go into DC, I'd like to buy a portfolio from somebody that owns it, that I can take that small operator and he or she runs that operation for me, right? So that, especially in a market like DC, because you can go, certain blocks get certain rents, certain blocks don't get certain rents, and you think there's no difference, but there is. And you need that local expertise to tell you the difference for that. I'm sorry, go ahead.
Sorry. So you're seeing a demand for walkability. So are you targeting on buying mixed-use projects right now?
We've got some of that, but it's more where it's it's primarily office. We'll have a component of it. But we own a couple of buildings that are high rises where the top part were condos, right? And it's been separated in terms of the ownership. So we just bought the fee simple office. It has restaurants in the bottom, has condos on the top, but we just bought the office part. And we do very little development. I've never been I've done development. Talk to a developer and they love it. You can kill it on development, but I worry about the risk. I don't think for me the risk is worth it. I mean, you can take 3 years to buy the land, entitle it. That could be short. Design it, build it, lease it, and then ultimately sell it or keep it. And the world can change in 3 years. I could buy a $500 million portfolio in 60 days. We'll work like hell to get it done. But I know where my market conditions are, what my interest rates are, and unless you're really going to, and the problem that I see right now is development is being done at very skinny returns, today. And to me, it isn't worth that risk. And I'm not going to develop to a 6 or a 7 and hope cap rates stay historically low at a 4 and a 5, because if they move up, you've made nothing. And so, I want to get paid for the risk, and it takes more patience than I have for that. And now some people have done well, but a lot of those national developers got clobbered when the market turned back in '08. Not that we had loans to restructure. We were doing loan restructurings that I never even heard of before the market turned. A and B notes with the special servicer. it'd make your head spin, some of the stuff we had to work out and do when everything came down. I had, one of my family members says, well, I don't know how does that hurt you? I said, well, if you bought a building and you put, and we didn't do high leverage, but 70% is not high leverage. There was people during that market period who were taking mezz all the way up to 90%. And so if the market drops 40, 45% and you got 70% debt, your equity's gone, right? As long as you had a non-recourse loan, they didn't want the keys back. So you ended up, if you were prepared to put in new money, and my partners were prepared to put in new money with us, just like George Perez did down in the condos in there, his same people came back in and bought those things again, you were able to restructure the loan, and you made up for the money that you might have lost by putting in the new money at very attractive terms. So I don't know how I digressed into that, but hopefully that answered your question.
Yeah.
All right.
When you talk about the B and C office and retail that you see, and you think that they'll eventually be going,
it's not everywhere, but I think it depends on the location, right? If you're in an infill location, you can reposition an asset, but what I'm talking about is more these, so much of it was built too. If you go to suburban New Jersey and New York, you can't find tenants for those properties. They've all come to Florida, by the way. So we have stuff in the Deerwood submarket of Jacksonville, and Deutsche Bank, JP Morgan, Fidelity, they're all there. They used to be in those locations. I just don't know what you do with those at that point in time. It's not uniform, but it is, as a product type, it's I don't see it coming back. But go ahead, I'm sorry, did you have more to that?
how do you see people repositioning those, or do you see them being redeveloped? And if you do,
it's going to, like I mentioned, the Maitland Center, some of these properties just didn't get leased. It depends on the price point. If they, at some point, the owner of that's going to have to realize, I can't lease it. The capital that I have to put in isn't going to come back to me, never mind a return on that capital. So when that realization hits and it's sold for almost the land value, then it'll be redeveloped and it'll probably just be torn down. And if I look at a Maitland Center, that is more of an infill component to it. So you probably would be looking for more multifamily, high density residential there.
So do you think that the sort of biggest advantage that the Sun Belt has as a market is just residential desirability, people trying to get away from the snow, or is it a bit more complicated? No, I think it's more than that. I mean, we've got in Austin and in Phoenix, and we're in Tempe and Phoenix next to Arizona State. We've got high-tech firms from California coming to those locations. That's just the cost of doing business. And it happens to be, there's a talent pool from the universities. The people who they're hiring, they can afford, the housing is more affordable. So you've got two things. You've got corporations, in-migration of those corporations coming into our markets, and the general population growth of the markets tends to support growth in the industries that are already there. And so if you look across the markets, and we have a graph in our presentations that we do when we're talking to investors and analysts, if you look at the U.S. Average, and then you look at our markets, so the U.S. average is here, and our markets are all up here in terms of those two components, job growth and employment growth. And I think what's changed in the Sun Belt markets is the markets that I've referenced, you look at a Buckhead or you look at an Austin, downtown Charlotte, is that they've become more dense and more urban. There's been so much of stuff that has been developed, and if you looked at it 10 years ago, you wouldn't believe where it is today. There's been so much development in there that it's become very dense, very urban, and as a result, it's just, like I said, it has that dynamic of increasing replacement cost. Because don't forget, if you're buying something, it's not just what it takes to replace it from sticks and bricks, but it's locationally,
right? I mean, if you want to get in locations that are unique, access to the various highways, the amenities, as we said. So if you've done your job, someone could build another one, but they're going to build it in a worse location. Or if they're going to be in that location, they're going to have to tear something else down and pay a fortune to go do it. And so therefore, it's just going to be cost them more and more to replace it. But everybody, you know, we have to sell a lot on the road in terms of investors and analysts as to, you know, why they should invest in the Sun Belt. And, you know, we get them down to look at it because the perception is they think we're a suburban company, but none of our assets are really suburban. Until you come and see what these markets have become. I mean, if anybody's been down to Brickell lately, you'll know what I'm talking about. And so it's changed, and I think it will continue to change because the growth is all coming to those urban cores and less in the suburban. I mean, Atlanta, you know, it's so spread out in Atlanta. Some of those buildings out there are never going to get leased, but Midtown and Buckhead will be the desirable location, and Central Perimeter too as well.
Do you think? What's the deal with downtown Atlanta? Do you think that vacancy rates are
Forget it. I mean, they've been talking about getting that better for years, and it's just. First of all, you had a lot of the law firms that were down there, and they've all moved to Midtown, and they're all downsizing anyway. You know, Midtown next to Georgia Tech is much more of a desirable location than downtown. I mean, it's government primarily, but I mean. Cousins owns a building downtown. It's probably one of the most beautiful buildings you've ever seen. If 191, I don't know if you've ever seen it. It's downtown. That's those two. It's like 1.3 million square feet. Large, beautiful inside. Nothing but stone and marble and granite. And they filled it up, but it was all kind of related parties. I mean, they could find a buyer, but it was it was a number that was so low because it was downtown. So I wouldn't invest in downtown on the hope that's going to turn around. And we're in West Shore in Tampa. We're not in downtown Tampa because, you know, I think that's suspect as well too, downtown Tampa.
How far north to you does the Sun Belt end? Is the Memphis Sun Belt to you? Is it Louisville?
No, but I'd rather be in Nashville if I was going to go somewhere, you know, or maybe Denver. It's a stretch. But those are two markets we like in terms of the demographics there. You know,
or Boulder?
Both, Denver and Nashville, and DC. Like I said before, if I was to say where would Parkway like to expand, those would be the markets that we try to. But again, you know, in an ideal world, if you're going into a new market, I would prefer to buy a portfolio than I would buy a single building because I think with a portfolio I can put the right people on the ground to give me the intel versus just one property. It's not efficient to run, and usually the rule of thumb is about 1.5 million square feet in a particular market where you're paying a kind of regional manager, as we call them, and all the support staff to run that market. And so, you know, the scale is important. So I'd love to get in there in a bigger way than just buying one building, and that's been the problem. We've only been able to identify small ones here or there.
And you seem short on California as a whole. You just think the costs of doing business are just...
Well, it depends where. If you're in West LA, no. I mean, that's the market there. They charge rent by the month there. If you ever been, you know who Eastdil is, right? Eastdil Secured. If you ever go in their offices in Santa Monica, it's on the ocean, right? So the ocean's here, the mountains are behind them. You go from one end of the office to the other, and you can look at the ocean and see the snow on the mountains on their office. They charge, I don't know, what is the number, $12, $15 a month for rent, right? So that's higher than Manhattan for that location. So, you know, West LA, but there's like two groups that own everything there, so it's hard to get into. I would have liked to have bought in Orange County when the market tanked, because, you know, that was the epicenter for all the mortgage related stuff, and but we had our hands full doing what we were doing, but that's come back pretty strong, that too.
Do you see Phoenix development stirring up any demand for the office buildings in downtown?
I wouldn't develop a new building in downtown Tampa, but I mean, there's been some trades lately. There's some of the towers have traded. I know that actually an ex-partner of mine just bought one, and then Highwoods bought the other one there. They're good-looking buildings. I just haven't seen the rent growth there.
Right.
That's the problem. You know, you need rent growth. I mean, because expenses will increase every year. And if your net rents aren't increasing with it, you can't create more value. And there hasn't been that much demand to push those rents up there.
What ways do you guys look to bolster rent growth? Are you guys adding value to it? People want to grow it, or just market conditions?
We try to make a difference when we buy a property. Sometimes it's minor, sometimes it's material. I mean, in Austin, we're taking this courtyard and we're doing a $15 million renovation, adding like a Todd English food court there, creating a restaurant pad. It's a major redevelopment, and we get a return on that development, and we also get higher rents in the building as a result of it. But even if it's something smaller, I mean, even in my private days, we would go in, we'd buy something, we'd add value, we'd lease it, we'd make some physical improvements, and then we would monetize it in 3 to 5 years because we were paid to hit our promote. And if your IRR hurdle, the longer you hold, the harder that is to hit. The public think is more of a longer term thought process in terms of how you hold these assets. But you still, no matter what we did, even if a building didn't need much, I don't care if I just went out and restriped the parking lot. I mean, if I'm going to try to push my rents and I'm a new owner, I want them to see some tangible improvement from me taking it over versus the prior owner. So you identify whether it's redoing the bathrooms or something that they can see is an important distinction. To do that quickly as soon as you buy, I think, is helpful. Because you're obviously going to do your best to increase the rents there as you take it, and they feel better about it if they see money being put into the property.
So some of the primary, where you get more than $1 out for every dollar you put in, almost always revenue drivers in residential are kitchen and bathrooms. People, you have a modern one, you have an updated one that drives a higher sale price, drives a higher rent. Have you found a similar trend for commercial where certain things just above and beyond outperform other investments you can make into a property?
I've got a partner who would never renovate a bathroom. He just said it wasn't worth. He didn't get an extra dollar out of doing that. So I mean, it depends. I mean, obviously the lobby and common corridors are your top 2 spots, right? Those are the things people see all the time, and I think those are the ones that probably make the most difference. And also the street level. I mean, I was a big landscape guy, especially in the South. I mean, that's pretty nominal incremental dollars to put in that can really make things look better. And it just looks better over time once you put it in, and it doesn't cost that much. So it's your appearance from the street that's the number one criteria. I mean, other than all the other amenities you need to have around it to do it, I think. With that, because I want to kind of move on, I think, in terms of the topics, which kind of leads me into the public-private, because one of the questions was, tell the students the difference or what you think pros and cons of public versus private, public REIT versus private. I will say that I'm not, even though I've had this job for 4.5 years, it's different in a lot of ways. It depends where you are. In my position, it's a much different risk-return profile. In that when you're running a public company, you don't have to sign any notes. You're not putting up any dough. I mean, and if you stay there long enough, don't screw it up, they give you shares every year. So you can accumulate some wealth over a longer period without taking that much risk. But it's capped. Right? There's comps. If I told you that the compensation studies that have to get done every year to make sure you're within your peer set, you're not getting paid too much more than a company of similar size and performance, it drive you crazy. So there is somewhat of a cap to it, but it's somewhat riskless in that you're not putting up your own money, you're not signing notes. In my private days, I had to put up the money, I had to sign the loans, but if it worked, the benefit, 100% of the benefit came in my own pocket. And so I think that's now, as an environment to learn and be part of, it's great because, I mean, I think it's probably a little bit more stable, secure from that standpoint. Again, we're back to I'm a big risk return kind of guy. I mean, in life, you've really got to understand your risk return component and be thoughtful about it. And make sure you at least know with your eyes wide open, here's the risk going into this, am I prepared to take that risk for the returns? Some people don't recognize that, and and then when things don't work, they're like shocked. There's always a risk to it, there's always a cost. So I think in the environment and the public, it's certainly a good entry point. It's a great place to learn. I track the REITs in our regions because I've bought and sold from them over the years, and generally they haven't performed that well. If you go look when these companies were first gone public, and it was in the early 90s, and that's when I sold mine one to 97. If you look at over that period, it's been like this. It hasn't been just an upward trajectory, even though it's been smaller. And one of the problems I think for them is they can't sell at the top of the market, and so they're bound by REIT restrictions. If you sell too much, your company is your G&A becomes outsized relative to the size of your company. So if I think right now, which I do, Austin is overheated. I can sell my buildings for $500 a foot. I paid $313 for them a foot. Okay, it costs you $375 to replace it, brand new, and there's some new development going up. So if I could monetize that, I would today, because I don't think it's going to $600. Because if you can build for $375 and there was that much demand, they'd be putting up new buildings left and right. And so you want to sell while there's still that kind of dynamic. Everybody wants to get in there. But if I sold out of Austin, now I no longer have Austin on the map. And now that's $500 million that goes. That's it's a meaningful component of the company. We become smaller. And I think if you're going to be public, you got to be larger, because if you're larger, if you wanted to exit a city, you can do that, and it's not going to the BXP, Boston Properties. They're so large, they can go sell a chunk and monetize those, and the investors like it, but they're big enough where they still rationalize their G&A and there's no problem. And so, so I guess my view is public works better if you're a much larger organization, but sometimes they do the wrong things by the real estate because they're worried about that quarter-to-quarter mark every time.
What's your thought on when a public, let's say the share price is trading below NAV? Like, how frustrating is that in terms of that your share price should be up, but you can't really, you're making good decisions in terms of the real estate, but you can't do anything about it because it's a public trading on the share price. Yeah, I mean,
It's not ideal. So that's the whole point, right? People say one of the reasons for being public is the access to capital, but it's not guaranteed. I mean, you don't always have access to capital. I guess you could, but if you think your assets, if you're trading at 15, you think your assets are worth 20, I'm not going to issue shares at 15. So you really don't have access to capital at that point. Now, when we first took over, I mean, it was trading really low, but the market conditions were such that we could buy assets that would create enough value at the right time in the cycle that offset the dilution of issuing shares at that lower number. So, and we did that. We did 3 equity offerings of over $600 million, three different tranches at prices below, but we did it. Each one we did was at a higher number. But you can do that if you've got opportunities to buy something that's really undervalued. The problem right now is I don't see much. I mean, Houston's undervalued, but it may be appropriately undervalued for some time. I don't know yet. So I think I've watched some of them. So sometimes they'll sell things for the wrong reasons. An analyst is putting out a report. They don't like a particular submarket. They don't like this, so they'll just dump it. And when I was private, I loved buying from them. And then when the market was the other way, they were great buyers. So I mean, I did better buying and selling to them. But now I run them. And so, what I would probably have to do if I wanted to monetize a city like Austin, like I mentioned, I'd probably have to go do a JV where I still keep my infrastructure in place. And then the question is, if I get, 500 million, 400 million, if I go 80-20, what do I do with the money? Do I make a special distribution? Do I just pay off debt and be lower levered and be ready to take advantage of opportunities going forward? I don't get to put it in my pocket like I do when I'm private. And that's, so you may have done all the right things, but you're not getting paid for it. But then if you're a senior person and you're the CEO, the price is down. Every year you get grants, you get them at a lower price. So, I mean, that's why I'm saying a lot of them, not that they don't want the share price to go up, but it's a little bit, where if I just don't screw up, I'll be fine. And the analysts and investors that I talk to are very frustrated that there's entrenched management in the REIT world generally. They think there should be some consolidation, there should be more M&A. And I've talked to a lot of these guys in my space who I thought might make sense, and they all say the same thing. They'll do it, but they can't leave. They want to be the guy running it. So at some point, someone's got to give up a chair. So the good thing is I got a chair available if somebody wanted to do it, and they know it. So, I don't know. It depends on. It's gotten much more universal from an investment vehicle. In other words, there's more and more. I think they're going to be in the S&P as a class now, the REITs. So it's become more and more of a traditional investment security than what it was before. Lots of transparency. I mean, but I will tell you all. I mean, I spend 40% of my time dealing with non-real estate related issues. I prefer to be out in the markets at the real estate, talking to the brokers, because I sit down and I have a dinner with the top brokers in the town. I find out more at that meeting and dinner, the more wine I give them, what's going on there, than sitting in my office, right? And I spend more time going to talk to investors and analysts and calls and accounting and all the various things that are away from the real estate, just to make every quarter. Right? It seems like it's every 2 months, but it's every 3 months. And then we got to, and you're like 3 weeks out getting ready for the next board meeting, for the next analyst, for your earnings call, for your statements to be put out. It wears me out. I mean, that's, so.
Do you miss your days of doing it private?
Without a doubt. I mean, and let me remind you all, it wasn't like I came in here with intent to run a public company. When I did the merger, I had partners back, this is almost 5 years ago now, when the market was lousy, who needed liquidity. Parkway had a fund with Texas teachers, so they were one of the few people it's nice to have liquidity in an illiquid market. And so they had some liquidity, and we had assets to trade. Some of my partners, which were state of Utah, PSB in Canada, who wanted liquidity. And these guys also wanted to buy my operating platform. So we did that, and they paid up for it, but I came in as chairman. And then they had their own CEO, so I had never any intent to come in and be CEO and president, but then he would make the suggested changes that we thought needed to be made, and he resigned in 90 days, so I got stuck with the job. It wasn't with intent. So here I am 4.5 years later. I don't know how I got here. But, I could be digging ditches, so I can't complain. Anything more on the REITs? How are we on time, Doc? Okay. All right, let me get into the challenge of trying to invest for your own account when you don't have any money, right? Which is what I had to do, because I had no money. In fact, I had negative money when I graduated from here. So, I'm not going to get into how I got to where I was, but the thing is, if you choose to do this for yourself, and you want to be an entrepreneur, and you want to invest in real estate, it's obviously it's very challenging to do it when you have no money to start off with. It's great if you got a stake or your family's got money; it's a lot easier. So you have to get experience in the business for someone to even consider giving you the money to do it, right? So you need to get a track record of at least experience and expertise, because otherwise no one's going to give you money just because you came and asked for it. But if you have that, and for me, I finally got into the real estate business. I started out as an accountant at Coopers & Lybrand, which I hated. I mean, I was a terrible accountant. I was doing internal audit, and then did various different jobs, just to pay the rent, because you had to pay the rent. And so ultimately, I got a job. I was doing financial analysis for a large public company out of Pittsburgh who had a real estate department. Now, this is, fast forward, I'm now just almost 30 years old, and ultimately did some work for them. They liked me, and I got into the real estate department. And then once I got into that, I had the degree here from the University of Florida in real estate. I was able to, it was like, I liked it, which is most important. You're never going to be good at anything you don't like. You just won't. You won't excel. Nobody will notice. You'll hate it. You won't do. I hated accounting. And then once I was in that environment, it just, for me personally, it just fit. I was able to dealing with brokers and architects, and it was just something that I liked, and therefore I took an interest in and did well at. So I went from just being an analyst in these things, and in 5 years became president of a small public company out of Orlando, who was, they owned all the land at Universal. I'm telling the story all over again. You guys we heard about it before. So did that, and then they got in a hostile takeover, and then 18 months later, they had to tender to buy the company, and I was able to go to some people in the community who I knew, who had money, but who knew other people who had money, and said, this company is going to buy this, and these 2 buildings that I bought for them, they're short of their financing. So if you guys can buy these 2 buildings for this price, he can close on the deal. I get bought out of my contract, but you got to let me run these buildings for you, as was the deal. And so I was able to find, and these gentlemen had people in the Middle East. So in my early 90s, I was going back and forth to Dubai and Abu Dhabi before it was like it is today. Eating on the floor, literally eating on the floor. So what I did is, obviously I had a track record, had some experience. I wasn't, brand new in the business, but I got these people to investment. They didn't give me, I didn't have any ownership in it, but they put the money up and let me run it. And then from there, what I would do is find opportunities and bring it to those people or other people and say, now that I've got a little bit more of a track record, I've got an opportunity. If you buy it, I don't have any money to put in, but give me, whatever you can negotiate at that point in time, right? 10%, 20% over a 15 IRR as ownership. So if it works, I put no money in. After you eat first and get a 15 IRR, then I get a piece of the upside. Plus I get to keep the management and leasing for running the properties. So that gives me some current income. And so, and there's a lot of doors said no, but that's the whole point, is you've really got to go knock on your doors. You got to know your stuff. You got to have your pitch. You got to have your story. And you're going to be told no an awful lot of times. And I think I told this in Orlando, one of the things I always do when I go in there is, first of all, pay attention to who you're selling. I've had people who work with me who just don't, they want to talk and not listen. And so, you can tell whether someone's buying what you're selling if you're paying attention. And so I would watch, I could tell whether there's no way these guys give me money. So before they would tell me that, I'd say, listen, from everything you said, it seemed like it fits the parameters of your investment. Next time I find something, I'll bring it back to you. So I would kind of take it away before he told me no. At least next time you thought I had options, whether I had them or not. But, lots and lots of no's until somebody, either had an allocation for money or wanted to put it in that, or liked the investment thesis, whatever the reason is. It takes a while to find those people. But then once I got to some of the institutional capital, and I dealt with Starwood and GE and Lehman in those days, once you did 1 or 2 deals, then you were pretty set, as long as they performed, of course. Because now you've already negotiated all your documents. Now your time is spent finding the opportunities, and then you can roll and really grow something. Well, I tied in the Lehman in '94. We had a few buildings, but within 3 years before we sold to Highwoods, we were the largest private owner in Florida. And so, and the other thing is, you got to think long term when you're dealing with people. You will do more, you'll make more money dealing with the same person over and over again than going with, because you've conducted yourself poorly, and either you took the last penny off the table, you didn't treat them right, and you'll run out of people to invest with you. You want more people wanting to invest with you, and it's how you conduct yourself. And so the old saying, think long term, and it's amazing how short it'll occur, is true. And so, you need to think about that. And then once you tie into that, of course, you got to operate and you got to perform. And so the bottom line is, you got to get people to give you more money than you could ever hope to pay back, and then work your ass off to make it work. Right? But it can be done. And it's been, there's always somebody. Now I look at where I'm at right now. And so whenever I'm done with this, there's things that I'm going to want to invest in. I'm not going to want to operate anymore. I mean, having an organization, an operation, something I wouldn't want to do, but I'm still going to want to invest. So if I find someone like I was 30 years ago, who can dig up deals and operate them and find opportunities for me to make some money, then I would give them money to do something, right? So it's out there, but you need to get some level of the experience before someone's going to even think about giving you the money. So with that, I've been talking for a bit. I'll pause for any questions for that. It's a piece of cake, right?
Coming from a primarily, office background and your work experience, are you privately as an investor comfortable investing in all fields of real estate, or would you stick probably to office and maybe multifamily?
There's things obviously that's similar to all asset types. I mean, when you run numbers, but he mentioned apartments. And you build apartments, you got to know what size the bathrooms need to be. What's the price per square foot for these units? I mean, you got to really know your stuff and those individual stuff. So I would feel comfortable investing if somebody else was my partner who was a multifamily person, right? And I think I mentioned to you guys, I mean, I'm a, post Parkway, I'm a big believer in, just multifamily residential, not necessarily, they're putting up a lot of it right now, so it's a little scary in terms of how much. That's one of the product types I think is getting to be a little bit oversupplied. But long term, the technology is not going to affect that. In that, office could be affected more, retail could be affected more, even industrial, right? How things are delivered and shipped could change. But everybody's going to still want to come to Florida, and people are still going to need a place to live. That's not going to change. Technology is not going to change it. And being a low-tech guy, I worry because I don't know enough of technology that how quickly a business could go out of business because of technology. And so as I think about it from an investment standpoint, my view is that the technology, now granted, what's in those apartments and the technology and the amenities and things that are related to technology that should be in those apartments will change, but not the fact that people need a place to live. And so, as I think about it, what I would like to do myself would be, I'd like to either redevelop or develop more smaller boutique infill residential, more like 40, 50, 60 units. But you provide them all of the amenities, all of the state-of-the-art technology, and those I would own for the long term. I wouldn't do them, or wouldn't build them or renovate them and then sell them. I'd hold them.
Do you guys use a lot of CMBS for your debt? And if so, has the last kind of 6 months or the CMBS kind of up and down affected you guys a lot?
Well, we don't use much CMBS. We use more corporate level debt. So unsecured borrowing. We've got half of our assets, at least, maybe now 60%, are unencumbered on a secured basis. Going through the last cycle, the CMBS, when you want to transfer a loan and get a loan assumed, I mean, it is a process with the CMBS loan because there's no one person who can make a decision. And so there's mechanics of it that you can get some good pricing, not right now, but you can get some good pricing on it. But it's when don't forget, always get financing knowing what your exit's going to be, right? I mean, don't get short-term, low leverage, a long-term rate if you're planning on selling something in 3 years, right? And you'd be surprised. And whatever your business plan is, match your debt to the business plan, because that debt will be detrimental to you if it's not either can be assumed at a high enough leverage, or depending on the rate environment, whether you lock it, whether you float it. I mean, you got to tailor it to what you're going to do how long you're going to hold the asset. But the CMBS it's coming back in right now, but you couldn't get a direct quote. You couldn't say it's going to be 220 over treasuries. We think it will be this, but you really won't know until the last day, till they actually sell it. Whereas before they would lock it and you knew. Right now it's a little bit turbulent out there. And at least we've done some. It depends. If you're doing lower leverage, life companies are great because there's somebody there to talk to. And so you could always do a blend and extend if you have someone there. When you're doing in a CMBS world, it gets handled by the master servicer, and it's a neverland. Hard to get anything done. I know I covered a lot of ground. Is there anything else that I can answer for you guys?
Do you go to banks strictly for financing, or do you ever get advice from them?
Well, the world changed quite a bit after the last downturn. The banks or the investment banks, they're all one and the same anymore. We go to deal with Wells Fargo, but we deal them on the investment bank side. But what they provide us, a couple of things. They'll provide us our line of credit. The company has a line of credit because when you have an unencumbered pool of assets, it's easy for them to give you a corporate line. And then when we float either bonds or term loans, which are again unsecured, they're not secured at the property level, the banks will provide us those. So you'll get a banking group of 3 or 4 banks that will take down a $200 million term loan, and so that'll be a Wells Fargo, a B of A, a PNC, and they'll package it together. There's always a lead bank in that. So. And we tend to use both B of A and Wells as our primary bankers, but you have to deal with all the rest of them because anything you do large, they have to syndicate it to other people. So, and it's amazing how skinny the spreads are on that stuff, how little they make on it to do it. Because if you think of the world post turndown, it's a much lower leveraged environment. The REITs are very low leverage. They're 30%. 30, 40% is high. And so, they're in a much different position than before, so they're not using all the capacity. So the lenders are fighting for business for that right now.
As you see the industry moving forward, we're just now starting our careers in real estate. Where do you see the long-term opportunity, 30, 40 years, for us now going into the industry? You mentioned multifamily.
Well, I like I said, I think, you all are much more tech savvy than certainly I am or were. So I think you really need to pay attention to those trends when you make your decisions, which direction to go. I do think that the higher end product, at least in terms of multifamily, now that's not true. Multifamily, the suburban garden apartments is still, there's always going to be a need for that as well. It's a price point. The retail is challenging right now, as I think office is. If I could come back all over again, I would do industrial. I mean, it's the simplest, easiest thing to do. There's not much capital cost, but in terms of invested dollars, you've got to get enough of it because it's not that expensive, right? So to get a portfolio of any meaningful size, you've got to own millions and millions of square feet, because if it's trading for $60 or $70 a foot, whatever the number is, most of these institutions that they want to own that big time, but they'll only buy it if they can buy a big slug. They're not going to buy a 200,000 square foot warehouse and own that for $10 million. They're just not going to do that. But that's a very good business in terms of going forward as well too. But again, pay attention to the technology trends that affect that stuff. All this, I don't know, if people can take drones and deliver stuff to your door, I don't know what that means, I don't know how bad that changes things, right? But I guess they got to have a warehouse to warehouse it somewhere. So, I'd just be on the lookout. And also, it's what you like. There's always going to be opportunities, and if you're paying attention, and one of the things I always tell people, people say, I get asked a lot by the analysts, when is the next cycle, or when do you know? I said, you never know. What I do know is it's always for a different reason. Every time if you think about it, look back on, I've been through too many of them. Each one of them was for a different reason. This was obviously a credit issue, right? It wasn't oversupply. Right now, we have very little supply. In the 80s, it was huge oversupply. Then you had the savings and loan list. So it's always been something that nobody anticipated. Now, if you saw The Big Short, somebody anticipated it. So I'm just saying that, you got to pay attention to these. If things are rampant and going so fast and everything looks great, always pause. You got to look around you. I've got a story of there was, I tried to convince this one group to sell some things we had. And he was convinced that it was going to be, worth more because look how great everything's going. It's got to be worth more. I said, but you've hit your 5-year business plan in 2 years. Okay? Don't be greedy. You hit it in 2 years. I can guarantee you that the upside potential is far less than the downside risk. And so things just don't keep going up, right? And always keep some liquidity. I don't care whether you're in your business or just in your home. I mean, you always have that, because it's amazing the opportunities that you can find, as I said before, when you've got liquidity in an illiquid market. I don't care whether you're buying a house or a car. When the market's in the tank and you've got some cash on you, it doesn't be a large amount of cash, for whatever it is you want, you can be opportunistic. You can't be if you're over leveraged. And leverage is great on the way up. I mean, it's great on the way up. It's a killer on the way down. So, now, with that said, I levered the hell out of my first stuff when I was ramping up before I sold the Highwoods, right? Because if I didn't have any money, the more leverage I got, the more ownership I had, but then again, I didn't have anything. So, I didn't mind taking the risk, because, I think I told the story down there. Worst case, I always felt I didn't mind taking risk, because, I felt I had a degree from the University of Florida. I'll always get a job. Worst case is I'll find something to pay the rent. And so that always gave me comfort. But, everybody's different, but to the extent you can, always, be in a position to have some dry powder, because the returns on that dry powder at the right time can be very, very large. What do you think, Tim? How are we on time? Are we good? Then I gotta roll. Well, thank you all. I enjoyed. Hopefully, I answered and gave you guys some insight. So, thank you. Good? Everything good? Good. Thanks.
Thanks for coming.
My pleasure.
Carrie Froelich.
Nice to meet you, Carrie.
Here's my card.
Oh, thank you.
I was actually just thinking about industrial, because I had an interview with an industrial broker, because I'm looking at brokerage.
Which is a great way to start and get experience. It really is. It really is.
Okay, that's good to know.
That's a great. Anything that allows you to see kind of the workings of a transaction are huge.
Okay.
I think.
Yeah, I mean, I like that transactional, just going out and meeting people, seeing.
Being in the brokerage or in the financial analysis area where you're seeing it from A to Z is helpful.
Okay.
It's the only way you learn.
Awesome. Thank you very much.
All right, pleasure.
My name's Ian Mitchell.
Ian?
Yeah. I'm currently working with my parents. They have about 150 units of residential property between Florida and Cincinnati. What we're trying to do is pretty much all of our debt we got 2008 or before. So we've built up equity in that. We want to refinance because the debt we've got is private lenders, and it's a lot more expensive than what we can get these days.
Well, the life companies love the multifamily. The CMBS is a bitch.
Well, Cincinnati is pretty much all multifamily. We've got about 90 split between 60 units and 30 units of apartments, and then Gainesville is duplexes and fourplexes. Yeah, and it's new because in a lot of ways I went to business school. I never get a lot of the ways that they run their business are. It's been very hard to get what I need to properly get the lines of credit.
Well, you already having something already done. And guys, I got to jump on a board call. I'm sorry.
Definitely. Well, thank you so much for talking to me. Appreciate the talk. Yeah, I mean, I kind of learned between me and I do that for 8 years. Well, I started undergrad when I was 16.
Yeah, I actually pretty
It's
much.
been 8 years to do that, but I think I stayed around. And now it's
Well, no, I'm not. I glanced at it. It's remarkable.
Pleasure to meet you.
Really, really cool.
Yeah, I might have to sit in on more real estate stuff.
Yeah, I'm ready. Well, that's what I said. I'm fine. So you notice like I'll see you tomorrow and we can just talk about it. Maybe Todd's got a place around after he's called.
Actually, they didn't do a bad job. Really? Sure.